My next guest says next week's rate cut, regardless of all this slicing and dicing, should be the last one. Joining me now is Greg Daco, chief economist at EY-Parthenon, and Brian Weinstein is head of global markets at Morgan Stanley Investment Management. Welcome to both of you. Who says this is the last cut?
And that's me.
Brian, go ahead. Make your case.
Listen, I think it's been a very odd couple of months. So the Fed was going to ease 100 basis points coming out of the summer regardless. It's not in the data. There's something about today's data that would have changed that, I don't think. You could have gotten a 0.4, but we haven't had one of those in a while. So I think what the Fed did was calibrate. I don't know why they made it so complicated. I don't think it was a big data story. Yes, employment's a little bit weaker. Yes, inflation has come down. You could take out housing and it looks better. But I think they calibrated. 5.5 seems uncomfortably high. It's not neutral. It's above. Things are weakening. They're more neutral now. They don't know where neutral is. 4.5, I think they have to pause here for a really long time because you have policy coming in as a tailwind. You have equity markets doing great. You have earnings looking strong. Inflation's not going back to 2, so they're waiting.
You don't think this is a story of, CPI is actually fine if you exclude rents, and rents are lagging because market rents are actually much lower than the rent readings that are showing up here?
No, not particularly. I mean, again, you can slice and dice. You can make the story, however you want it to go. The way I look at it, inflation is within what the Fed said in their forecast, so they can ease again in December comfortably. Again, 4.5%. No one would have believed we would have gotten here a couple of years ago. So I think it's a fine place to be at. But I think if you ask me, is inflation going back below 2 comfortably, the answer is no.
Right.
I think inflation's 2 to 4, and it keeps pressure on the Fed to not go too much further,
and
or at least not for a while.
And on yields as well, which I want to circle back to because you can kind of talk us through that. Greg, I'll let you respond. I mean, I don't know if you share that. Are you hawkish or dovish today?
Well, I think generally speaking, the market's perception that there is almost certainty that there's going to be a December rate cut is misguided. I've argued that actually we should have market odds that are closer to 50% given policymakers' extreme data dependence and given Fed Chair Powell's agnostic optionality when he goes into meetings. I would still view the open optionality for the Fed to cut rates at the next meeting, but I would anticipate that there's going to be a longer pause before the next cut after that. And as you well know, the policy mix that we're going to get in 2025 is likely to be inflationary. Whether it's deregulation, immigration restrictions, tariffs, or tax cuts, they're all likely to put upward inflation pressure on the economy, and that will likely lead the Fed to be a little bit more cautious. Honestly, I'm not too concerned about underlying fundamentals. They're still disinflationary, whether it's consumer prudence, reduced pricing power, wage growth in an environment of strong productivity, or now decelerating housing inflation, they're all still disinflationary. So the near-term momentum is very encouraging from a Fed perspective.
It's weird, Brian, because the market is in a very dovish mood. And normally people go, oh, the market always wants rate cuts. Well, they don't always price for that, though. I mean, a lot of times they've been wrong. They've been more. Why is it that investors in kind of this sum total of human knowledge that we have at this point is saying they're going to cut again this month, they're going to cut 3 to 4 more times next year, even though we're all making the case for why they shouldn't do that?
A couple of reasons. I think it's been a long time since we had a recession, so it's easy to say, well, it's coming, and it's been a tough trade, but you can say it. It feels like
do you think there's a recession trade in those rate cuts?
I do. I do think there's a group out there that thinks that employment is much weaker than it looks, that you won't get, that we've already priced in the big bump from the administration, and that on the other side of this is the actual slowdown that's coming. And I do think we're addicted to liquidity. I think the economy does even better if the Fed cuts to 3.5. I think that would be a major mistake and an inflation problem. What's amazing to me is we haven't priced in any more inflation. The market's been very benign. We're pricing in growth, right? This is a growth story. The market has remember all we could talk about was inflation. Mm-hmm. That's no longer true. Mm-hmm. Break-evens haven't really moved much in, 6-8 months.
Yeah.
So I think the inflation story is going to happen in the second half of next year. What we have here is a growth story, and it's a good one, and the Fed should sleep easy at night knowing that they've calibrated, and that's why they can just stop, and that's why they should wait.